Neat. Okay, who has not answered the poll? There we go. All right. Right, welcome back to another edition of Intermediate Accounting 2. Almost screwed that up. We're going to finish up talking about chapter 15 today, I think. We'll have plenty of time to get through it all. So what I want to do is just look at the calendar here. So we've got our next exam, which will cover, some of you were asking me about this. The exams are covering 2 chapters. The midterm exams are covering 2 chapters at a time. So we got our next exam coming up next Thursday, the 17th. Today is the 11th. Exam 2 is just going to cover 15 and 16. Thumbs up if you guys are with me on that. Cool. And then we'll move on to 2021. That'll be exam 3. The final is comprehensive, but I will give out some notes about the previous chapters. Final exam will cover 22 and 23. Anything that's related to the previous material, I'll make sure that you guys know what to study for that. Thumbs up if you're with me on that. Cool. Cole, you there? Hi, Cole. Yay. All right. So let's jump into chapter 15.3 through 4. What I want to do is get through this, and I think what we'll do is at some point towards the second half of class, we'll get into groups, and I'll just check around to make sure you guys know what's going on in your groups. Some concern, we may have to shuffle groups here a little bit. I've got some people who've dropped, so some of the groups are disproportionately sized. I'll let you know about that if that needs to happen. Dividends and dividend policy. So when we're looking at a company's equity, and we see that they've got a lot of retained earnings. Below here, I did some snippets about Apple Inc. Apple has what? In millions, mind you. So you have to add 3 zeros. So if you look at their retained earnings for 2020, 14,966 stated in millions, add 6 zeros there. That is 14, not 14,000, not 15,000, not 15 million, but 15 billion, roughly about 15 billion in retained earnings. Usually when I teach this topic, either to intermediate 2 or to my financial accounting students, they always ask me, why don't they just pay it all out? I mean, that's essentially the historical retained earnings minus historical losses, minus historical dividends paid out. They still got quite a bit left, right? Well, do they have the cash available? And here is Apple's cash and cash equivalents balance at that same time period. Not 38,000, not 38 million, but they have 38, think about this, they have $38 billion in cash and cash equivalents. Wow. Why don't they just take about half of that and pay off the retained earnings, pay out the dividends, right? Well, the excuse is varied, but generally speaking, I would say it comes down to maintaining enough cash for growth or expansion. Keep in mind, companies need to have cash on hand to help with their current cash needs. At the very least, a company, big or small, is going to have at least 3 months worth of cash to help pay off any of the upcoming 3 months ahead payables, such as salaries and wages. But growth and expansion tends to be the biggest reason, and that's one of the reasons why Microsoft did not pay out any dividends at all, is that when they were young, they wanted to just keep growing and expanding. So they held back all of the money, didn't pay out any dividends. Another reason is to smooth out dividend payments. Generally, companies, when they start paying dividends, they usually keep paying dividends regardless of the economy, regardless of how the company is performing financially. So if the company starts paying dividends, it really cannot stop paying dividends. If they stop paying dividends, stock price takes a major hit on the market. So they'll keep paying out dividends. They just want to make sure that they can keep paying at least consistently the same amount they paid in the previous 3 dividend payouts. Build up a cushion against possible losses. A company like Apple has seen a lot of twists and turns throughout its corporate history. There was a time when Steve Jobs was not there, and Apple tended to suffer without him at the helm. So Apple is really robust right now, but keep in mind that at any point in time, companies and their performance can become sour. So it's good to have a cash reserve. One thing, we'll take a look at Apple later on here, but one thing you can see is that Apple's cash, 2019 was 48.8 billion in cash, and that dropped about $10 billion during 2020, majority of 2020. And one of the reasons why, well, this is interesting to me, because you would think that as people as people start working remotely, they need to up their technology, right? Well, maybe, but generally speaking, there was a lot of unemployment. So it's not like there's a lot of discretionary income floating around during 2020 where people could go out and buy computers. Also keep in mind too that if you looked at the 2020 overall GDP, you saw that we had a sharp decline because everything was closing down. So, Apple does have Apple stores, and they were necessarily shutting down some of the stores or putting them at least closed temporarily throughout the pandemic. So they weren't making a lot of sales through brick and mortar channels. But generally speaking, dividends, the retained earnings generally represent dividends potential that can be paid out, but companies aren't going to pay out all their dividends. If a company does pay dividends, there's some things they need to disclose. Companies should not pay a dividend unless the present future financial position warrants distribution. That's generally one of the reasons to hold back, is to say we're not sure if we can keep paying out dividends, like I said before. But even still, rewarding investors willy-nilly on dividends makes the predictability of those future cash flows undeterminable. So stock price in general won't price any payouts of dividends if it's not consistent or predictable. The SEC encourages, when the word encourage here is the key thing, it encourages companies to disclose their dividend policy in their annual report. It doesn't mean they're required to, okay? But if they do disclose, according to the SEC, what the SEC wants to see, that sounds funny to me, have earnings but fail to pay out dividends. You have a lot of earnings, you've been doing well, why are you not paying dividends? Company does not need to disclose that, but the SEC wants them to. If you do not expect to pay dividends in the foreseeable future, generally companies don't want to disclose that either, because that'll result in an immediate hit on their stock price. The Securities and Exchange Commission encourages companies to consistently pay dividends to indicate whether they intend to continue this practice in the future. So it's not, the SEC is encouraging this, but this is really more of a market-driven phenomenon. Investors and analysts like to see predictability in financial reporting and in management decisions. And dividends is something that is in the control of management, particularly the board of directors. There's different types of dividends. We'll explore cash, property dividends, liquidating dividends. Just need to be able to know these. By and large, cash dividends, so most people are aware of cash dividends. Some interesting phenomenons about dividends, such as stock dividends and stock splits. We'll explore that in a little bit. You're probably not really aware of this, but companies can issue stock as a form of dividends, but it doesn't cost any cash necessarily to the company. So we'll talk about cash dividends first. Process. The board of directors has got to meet, they've got to vote and say, yes, no, we're going to pay dividends, and this is how much per share. Generally, it's not disclosed in terms of a total amount. Usually they just simply say, here's how much we're going to distribute per share. Okay, we can calculate the total amount by multiplying per share times outstanding shares. If the board declares cash dividend, you need to realize that automatically becomes a dividends payable. That's a liability the moment the board declares it. But declaration doesn't mean payment. In fact, there are 3 different dates we have to be aware of. The board meets and makes a declaration. Those go into the board minutes as recorded by the board secretary. Immediately that becomes a liability. Then there's the date of record, which is a way to go out and figure out who owns currently the stock of our corporation. We get a list of names and addresses of people who own the stock. These names are the ones that are going to get the dividends on the payment date. So if somebody owns the stock at the declaration date, they don't necessarily get the dividend. It's only if they're still holding that stock at the date of record, when the company goes out and tracks down who owns the stock. Thumbs up if you guys are with me on this so far. So the cash dividend, we'll try to keep this consistent. They declare a 50-cent per share dividend on 1.8 million shares outstanding. Okay, cash dividend will be paid on July 16th, declared on June 10th. Dividends payable the dividend will go out to those who own the stock as of June 24th. So I always recommend that you guys draw out a timeline. Always sketch things out on your scratch paper. It's so easy to misinterpret dates. On 6/10, there was the declaration. Then there was the June, and June and July almost look very similar when you're taking an exam. So always be very careful. June 24th, somewhere around here, 6/24, there was the date of record. Who owns the stock? Okay, come up with a list of names. And then come July 16th, we are going to pay. And usually we just work with the brokers to directly deposit those amounts into the brokerage accounts. So that becomes cash that can be used by the investors, or the check gets mailed to investors. That's an old school way of paying dividends. So we got $900,000 of dividends are going to be paid out. How do we record that? Well, first things first, we have to be deliberate in our journal entries based on each one of these dates. On June 10th, we have not made any payments, but there is a payable, there is a liability that we need to record at that time. Where are the dividends coming from? They're coming out of retained earnings. So that T account is going to necessarily reduce once we declare. On the date of record, there is no journal entry that we need to worry about. It's just a way of us, it's an administrative task we need to do to go out and we find out who currently owns the stock, okay? If I give you these questions on the exam, don't make the mistake of thinking that there needs to be a journal entry recorded on the date of record. A lot of people tend to interpret this as, well, record means record something, right? No, it doesn't. Date of payment is where we quite literally pay out cash. So necessarily the payment date is going to involve cash, and we are going to reduce the dividends payable account because we set that up. If we do pay on the same date that we declare, that's a rare phenomenon. But if we do pay on the same date that we declare, we wouldn't really have the dividends payable debit. We would just go ahead and debit retained earnings directly. But I've rarely seen that situation. We always have to separate out the journal entries based on payment dates. Thumbs up if you guys are with me on that so far. Cool. All right, property dividends. Now, technically speaking, isn't cash property of the company? Yeah, but what we're talking about is the property or the assets other than cash. If we do decide to distribute property, I don't really see this at all, okay? The idea here is we're talking about usually giving our investors, our stockholders, something of value that they can turn around and sell for cash or liquidate pretty easily, okay? We're not going to give them a bunch of old airplanes, okay, that we want to get rid of. That would just be ridiculous here. So we're going to talk about assets that are fairly small or easily divisible and can be sold quickly. We must restate first, whatever the property is we give them, we must restate that property to fair value before it's distributed. It's a key feature that people miss on the exam is making sure that they update the account balances prior to making any distributions. If we make an update to fair market value, we're going to have some sort of unrealized holding gain or loss. We'll just go ahead and report that directly into income. That's okay. We're not going to use other comprehensive income, other comprehensive loss in this case. What we're simply saying here is this stuff is not really going to be sold. It's really just going to be given away as a reward to our stockholders. So it's okay to go ahead and report any unrealized holding gain or loss directly into income because this stuff is going to be offloaded very soon. So in the case where Beerbo declares a property dividend, the property to be distributed consists of 10,000 shares of another company's stock securities. This is typically the type of property that is distributed. It's not our own stock, it's someone else's stock. We're just trying to take our investment in marketable securities and just give it to our stockholders. Rather than give them cash, that seems like a fair thing to do. Currently, the securities are reported at $90 per share. On the date of declaration, the closing price of these securities is $100 per share. Property dividend will be distributed on the same date. So you still want to go through and write out your timeline, but go through and do your analysis. Currently, what's the balance in the equity investments account? Well, it's based on the $90 per share times those 10,000 shares. That's currently what we'd see as the balance in there. And just assume that we're going to get rid of, these are the only securities we hold as an investment. And this is going to be given in its entirety to our stockholders. So keep it simple in this case. $100 per share is a current fair market value. You must calculate the unrealized holding gain or loss first. Don't make this mistake on the exam. Don't rush into it. When we have our date of record, not date of declaration. Yeah, declaration. Equity investments needs to be adjusted upwards. So that investment account is going to go up. We're going to report any gain or loss, holding gain or loss, into our income. First, though, we've done our adjustment. Now that we have these things adjusted, we can then determine what the journal entry is for the dividends payable. The only real difference here is we're using a specific account called property dividends payable. Dividends payable is fine too. We're just kind of being sort of nitpicky about the titles here. We're saying, in this case, because it's not a cash dividend, we should put in the word property before that title. So overall, this is the fair market value of those securities. That's what we're going to give to people. That's what we're recognizing as our liability, not the current valuation cost, but the fair market value as of the closing date, the date of declaration. No journal entry on the date of record. When we make the payout, we're just emptying out the payable account. And in this case, we're not crediting cash. We're going to credit the equity investments account. That's going to go away. So we empty out the dividends payable, empty out our investments, and we preserve cash. Not too bad. Thumbs up if you guys are with me on this so far. Andy Kwan, how you doing? It's Andy Kwan listening. Hey, buddy. Liquidating dividends. This sounds weird. Liquidation, I don't really like the title of this. Liquidating doesn't mean, oh, we're going to give something that's really kind of like sloppy and messy and liquidating. No, what typically in business, when you hear the word liquidating, it suggests that we are liquidating the company, meaning the company's possibly going into bankruptcy. So that's not really what this means. Essentially, this is sort of a, I don't know, it's kind of just a arbitrary sort of decision that cash that's being paid out should not be entirely debited to the retained earnings account. Liquidating means that some of the dividends being paid out is considered based on retained earnings, but the other portion is not based on earnings. It's considered a return of capital. So companies can make this declaration if they want. What's the consequence, really? Well, here's how it goes. Beerbo is going to declare a dividend totaling 1.2. It indicates in the board minutes that the first 900,000 should be considered a distribution from earnings, like a typical dividend, like a typical cash dividend. The remaining portion should be considered a return of capital. So how do we deal with that? It depends on what our account balances are. So same other facts, we're going to basically break down total dividend between that which will come out of retained earnings and that which will come out of something else. Retained earnings, that's the cash dividend, our typical cash dividend that we pay out, is going to reduce retained earnings. The other portion is a return of capital. So paid in capital is the capital that was given to us at inception. Now we are paying back some of this capital to the extent of the 300,000, the remaining portion of the dividends. All of it's still going to be dividends payable. It's still going to be a full amount that we pay out in cash. So what's the difference here between what we've seen before? Basically, companies just making an arbitrary cutoff point. And they're saying, hey, dividends are going to come out of retained earnings. to the extent of 900,000. The rest of the cash is considered a return of capital. Does this ever really happen? Not too often. Generally, the only time I ever see this is where retained earnings, say for instance, only had 900,000 in its balance. If the company wants to give out 1.2 million, it clearly doesn't have 1.2 million in retained earnings. So it could just exhaust its retained earnings, make that go to zero, and say, then whatever the paid in capital account is, just go ahead and debit that 300K and reduce that sucker down. But again, like I said, I don't really see this too often. The motivation behind here, you just need to realize that companies can determine how much of the dividend is coming out of retained earnings and how much is considered a return of capital. Thumbs up if you guys are with me so far on this. Cool. Stock dividends and stock splits. These kind of sound the same, okay? And we're going to go through an example to see how they might be similar. But generally speaking, we're talking about rewarding our customers with more stock. Hey, I took the risk as an investor to invest in Microsoft. Okay, great. Microsoft earns a profit. They're doing really well. Then they say, hey, we're going to declare a dividend. And I, as an investor, thinking, yay, I can't wait to get my check in the mail. They say, no, 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 no. We're not going to give you cash. We're going to give you more of our stock. And I'm thinking, yay? I don't know. Is there motivation behind doing this? There is. There is a reward that's still felt by investors, because you have to keep in mind, if I don't get cash, but I get something else that I can turn around and sell very quickly, like the company's own stock, that still is something I can turn into cash anyways. It just requires me to pay out some commission fees. So stock dividends are the stock issued, the stock issuance of a company's own stock. So this is kind of like going through and issuing brand new stock. Distributed on a pro rata basis, which basically means if you were 5% before, the stock you're going to get is 5% of the new issuance. So whatever dividend, whatever stock is being issued out as a dividend, we're going to give existing stockholders their percentage of that new stock issuance. And the reason why we do that is because they will, after the fact, still hold on to 5%. So we'll go through an example of that, but the pro rata basis is necessary to make sure that everyone still holds on to their percentage of control. It says used by management when they want to capitalize part of earnings, which is not necessarily something that intuitively makes sense. It's just more theoretical. The idea here is if our stock is doing really, really well, why not use the market to reward investors? And that seems kind of strange, but if you think about it, I'm not giving, if this is Beerbo, I can give investors directly cash, okay? But if I give them instead some other stock, they can turn around, sell the stock, and then get the cash. So what's the company, what's really the cost of the company? Any type of like legal fees or administrative fees associated with this new stock issuance, which I don't want you to worry about in this case. I just want you to sort of focus on what the basic journal entry would be. In this situation, Beerbo preserves stock, preserves cash. It issues more ownership, but not really. Everyone still has their same proportion ownership. The individual investor looks at this and says, oh, wow, thanks for the stock, turns around, gets cash, and they still feel like they've been rewarded as if they were getting a cash dividend. But Beerbo's over here smiling and snarkily says, yeah, you think you got it good. I just gave you more pieces of paper. Okay, fair enough. But it's still something that's valued by the stockholders that preserves cash from the company. There's a difference, there's a threshold we need to worry about. It's generally the 25% threshold. 25% stock dividend or less. The book talks about 20 to 25. I usually just cut it off at 25. 25% dividend. What does a percentage dividend even look like? Beerbo declares a 10% stock dividend. At the time, the company had 450,000 of stock outstanding. So 10% stock dividend takes that 10%, multiplies it by the current outstanding shares of stock to determine how much of new stock or shares are going to be given out. Okay, so 25% means we're going to give out whatever the current outstanding stock is. We're going to add out there another 25%. If we have 450,000 out there, we're going to add or put into the market another 45,000 shares, or 10%. Okay, keep in mind, a lot of people look at this and say, well, aren't you, by doing a stock dividend, aren't you necessarily flooding the supply in the market? Remember, this is supply and demand. Okay, if we push out the supply a little bit, this is supply too, you can see that yes, indeed, the price was higher, and then as it goes down, as the supply of stock goes out there, you've got a lower price. But what are existing stockholders likely to do with that new stock? They're likely to sell it, put it out there in the market. And if they do, oftentimes what you see is a shift in demand. People look at that and say, oh, I can finally buy the stock now. There's a bigger float out there I can get my hands on. So over time, the price will rebound. But there is sort of an immediate shock where you see a price decline because we aren't necessarily flooding the market with 10% more shares. Everyone keeps the same ownership. There's just more stock out there. At the time of declaration, let's see, $20 per share. Okay, so this is the key thing. For small stock dividends, we need to pay attention to what the closing price is, the market value of the stock is at the date we declare them. This is a key difference from what we'll see in terms of a large stock dividend. So down below, there's the math, 10% times 450,000 outstanding shares currently. 45,000 new shares are going to be printed hot off the press, and everyone's going to get their pro rata share of those 45,000 shares. But you need to go step by step in the accounting. These things have a $1 per share par value. So multiply first the 45,000 new shares times the par value. What's the value as perceived, though, by investors? Current investors are looking at their stock and they say, the current value of each share of stock is $20 per share. So if we give out 45,000 new shares to existing investors, they view each share worth 20 bucks. That's the current market price. So to the investor, they look at this as getting $900,000 worth of value. We're not paying them $900,000 cash, which is what they probably would like instead, but we are rewarding them to what they perceive and the market perceives as $900,000 worth of value. Okay, thumbs up if you guys are with me on this. This is a good thing. This makes our investors happy because they can turn around and sell it 20 bucks per share, roughly. So we're differentiating the value that we're giving between par value and the rest being additional paid-in capital. So based on fair market value, this is the key feature. Go ahead and debit retained earnings, plug in the par value of the common stock, and the remaining amount is going to go to the paid-in capital in excess of par. What do we do, though, on the actual distribution date? Well, distribution is actually just going to be, well, excuse me, I should probably back this up here. First, we're going to take the par value and plug it to a liability account called common stock dividend distributable. Not payable, because we're not really paying money in the form of cash. It's a form of value that we plan to distribute. So distributable is the same thing as saying payable. Down below, when we actually quote unquote distribute, it's not really a date of payment, it's a distribution. We reduce the liability account and we credit the new stock. And the credit to the new stock account is based off of par value. Okay. Total amount of value we gave out was $900,000. What did it really cost me? Well, it essentially, when you think about it, take a step back, you have to realize that shareholders' equity, okay, consists of retained earnings. So if before I had, so retained earnings are just going to go, retained earnings account is going to decrease by 900,000. The common stock and additional paid-in capital increase first by the 855. And then eventually when we distribute that, there'll be a credit to the common stock account for 45. So what's the overall effect to stockholders' equity? Nothing. No cash is paid out. Stockholders' equity is the same total balance. Okay. Retained earnings, yeah, for sure, is decreasing, but that's simply because we are giving out more stock to people, rewarding them. They don't have to pay us for a secondary issuance of stock. We are basically giving them the stock as if we were paying it out in the form of a dividend. Is this very different? Thumbs up if you guys are with me on this so far. Okay. Think about it like this. How is this different from giving them a cash dividend and then having them turn around and buy new shares of stock? It's not. If we paid them cash, okay, over here, we look at the overall balance sheet, okay, assets, shareholders' equity, okay. We could pay them cash, decrease it 900,000. That would be a cash dividend where we reduce retained earnings. Right? We could turn around and issue another $900,000 worth of stock. And if we did at that time, we would potentially issue it at whatever the market price is. So the market price, if we turned around and issued stock near or around that same day, we would say, okay, common stock, APIC, issue brand new shares. See an increase, APIC would be 855K. Increase, common stock 45K. We'd see an increase of 900,000 cash from issuance. So what's the overall difference between these two? It's kind of like issuing, essentially giving out a stock dividend is like essentially giving people cash and then having them turn around and buy brand new shares of stock from us. Thumbs up if you're with me on that. Any questions about what I just did there? Keep in mind, this is not meant to be manipulative. Bottom line is, investors still feel rewarded, but the company preserves cash. Also keep in mind that when we issue those 45,000 new shares, everyone's going to get their percentage of ownership of the 45. So if you're a 5% stockholder before the issuance, you're going to get 5% of those new shares, or 2,250 new shares of common stock. Everyone else will get their fair share. So everyone's percentage will remain the same after we're done issuing these. What they do with it is up to them. Compare this to the large stock dividend. So this is something that people tend to make a mistake on in their exam. When we issue a large stock dividend, we're talking about 25% or more. Okay, so in this case, I'm going to go the extreme route. I'm going to basically say we're going to declare 100% stock dividend. That seems extreme, but what's the effect of that? Well, if we have 450,000 of shares outstanding and we issue 100% more of them, that means effectively that we are going to double the amount of stock that's going to be floating out there after we do the stock dividend. Thumbs up if you're with me on this. 100% is extreme, right? 450,000 new shares. Now, here's where people make the mistake. Yes, you first have to determine how much of that is going to be based on par value. Do the same process. Multiply the number of new shares times the par value. That's how much we need to record in common stock. Do not adjust to fair value. Do not do this, okay? It's a large stock dividend. And the reason why the FASB says don't record it at fair value is because essentially when you're giving out 25% or more of new stock, it's almost like a stock split. But instead of doing like a 2-for-1, you're doing like a kind of like a 0.25 to 1. So this is why we're kind of in this new sort of weird realm where is the stock really just a split of stock, or are we really just going to print off brand new shares? Here we're actually issuing new stock. So all of the retained earnings is going to be based off of par value. We're not going to worry about the fair value. Disregard fair value. Put it in the distributable account. When it gets down to the distribution date, go ahead and credit based on par value. Thumbs up if you guys are with me on this. Eli, you're not going to make this mistake on the exam, are you? You're going to make sure that you ignore fair value. It's one time where I tell people, ignore fair value. And they say, okay, just for this exam. Okay. I'm going to give you some homework that sort of forces you to consider the large versus small dividend payouts. Stock splits. A lot of people are confused by this. Microsoft did this for years. They didn't give out dividends, but they definitely wanted to reward investors. But in doing so, the idea behind a stock split is to take investors' existing shares they hold and essentially double or triple them. Okay? What's the reward to them? They have more pieces of paper, same percentage ownership. Generally done to reduce market value. That's the consequence. So if we have that supply and demand curve, what does the a stock split do? Pushes out the supply. Okay, more people are going to take those shares, put them on the market. As a result, chunk, we're going to have a new price. Price 2 is going to be less than price 1. The reason why Microsoft did this was because their stock kept getting bumped up more and more and more every quarter they reported profits. It became more difficult for people to come into the market and buy new shares to help improve the liquidity of their stock, reduce the price, and make it more affordable for people to come in. What happens to the existing shareholders? They get rich very quickly. Decrease in par value, increase number of shares outstanding. Here's the phenomenon. We're going to do a 2-for-1 split. What does that mean? After the split, each shareholder will have twice as many shares. You have 1 share, I'm going to turn that into 2. Poof, that's what it is. It's magical. So when you look at the before and after, yeah, we had 450,000 shares outstanding. But if we basically declare that for every 1 share, now you have 2. That's essentially doubling the number of shares outstanding. Mathematically, mechanically, that necessarily requires us to reduce the par value in half. If we're talking about a 3-for-1 split, brings it down to 1/3, and so on and so forth. So this is 1 over the split number, and this is the split number n times the outstanding shares. So we increase common shares outstanding, reduce the par value by half. Why do we have to do that mechanically? Because essentially, we need to make sure that the book value of common stock remains the same. We're not issuing new shares. We're not having an equity offering. We're not paying out dividends. Essentially, we're just telling people, you had 1 yesterday, now that's 2. Rip it in half. Each one is as good as 1. No journal entry is required. So make sure that in this case, if I tell you there's a stock split and ask you what the journal entry is, put down no journal entry in this case. All right. Thumbs up if you guys are with me on this. Stock splits are valuable. A couple things we need to discuss with regard to stockholders' equity are the presentation. One particular example, and there were times when I had to trim out some of our notes because I was getting too crazy with the balance sheet here. But a balance sheet portion where you look at stockholders' equity section, usually it's going to start off with your capital stock. So this is the stuff that's basically par value. If we have preferred, if we have common, and if there's any potential common stock distributable that we plan to give out to our investors from a stock dividend. Put those par values up at the top, put the apex after that. So excess of par preferred is 150,000. Par value is 3 million. So when you look at this is just the preferred. You had 3 million par plus 150,000 apex. So how much cash did we get when we issued the preferred stock to preferred shareholders, we must have gotten $3.15 million. How much cash do we get for common stock issuance? Well, the common stock dividend is sort of misleading because eventually we'll end up as common stock. But theoretically, the 4 million that you see there is 4 million par value plus another 840 APIC uncommon. So you got $4.84 million we potentially raised at inception. So I couldn't tell you this sort of in a kind of fast and quick and dirty kind of a way. You can't really look at common stock in general and say, oh, that's how much we raised at inception. Maybe you can, but we'll take a look at stock-based compensation where we necessarily see increases to common stock. And as a result, we basically consider that just employee compensation. Okay, so it's not necessarily the historic what we raised at inception of the company, but that's what I'm trying to get you at here, is just to look at these things kind of in tandem with each other. If there's any treasury stock APEC, you'd see that down there as well, because down here you see that the company has treasury stock 2,000 shares of common outstanding, 2,000 shares of common stock held. So key thing you want to be aware of here is that there are 500,000 shares authorized. They actually issued 400,000. So out went 400,000 shares, and treasury stock is 2,000 shares of common. So 2K came back. So how much do you still have outstanding? It's going to be the 398 is K is still outstanding in terms of number of shares. And there you also see reported any type of accumulated other comprehensive income. A lot of people report treasury stock down below by retained earnings. There are some other ways of presenting this information, and I look at this and say it's generally the retained earnings section is sort of like the catch-all for everything else. Treasury stock is somewhat viewed as the company, and also keep this in mind too, this needs to be a reduction. So that 190 needs to be reduced down there. The treasury stock essentially is a contra equity account. It reduces overall stockholders' equity. So retained earnings are the potential dividends that could be paid out. The company, instead of paying out dividends would reduce retained earnings, okay? But instead of paying out dividends, company goes out and buys its own treasury stock, buys its own stock, right? So essentially this reduction here, this treasury stock reduction is like saying, look, rather than pay every stockholder a dividend, which reduces stockholders' equity, let me go out and buy from existing stockholders their holdings of my stock. I pay them cash. In return, I get treasury stock. So cash essentially has been paid out to investors of 190,000. It's not a dividend, so we don't reduce retained earnings, but that cash, that 190,000, represents essentially a payout. We're just classifying it as treasury stock because in a lot of ways it represents sort of a contra or reduction to kind of like the retained earnings overall accounts. Thumbs up if you guys are with me on that. Cool. Companies must disclose a statement of stockholders' equity. They absolutely have to. It is, balance sheet is core. If you ever had me for a class before, you may have heard me say this. The balance sheet is the core financial statement, okay? On the balance sheet, you see certain accounts, one of them being retained earnings. And retained earnings is affected by what? Earnings of the company. So net income or revenues minus expenses plus gains minus losses. That's what determines net income. That goes into retained earnings. That's what goes into the overall equity, stockholders' equity. So the balance sheet, the company's net worth increases because of performance. So we need a statement of retained earnings and a statement of income. That's why we have the income statement and the statement of retained earnings at a minimum. Overall, though, because stockholders are not just all about the retained earnings, they're about their ownership of the company, we need to present more information. We do see retained earnings, And we do see the roll forward. So in this case, let's take a look at, where is it? Some dividends per share. So we can see down below dividends per share. We can see net income. That's kind of buried in here, okay? But I'm a stockholder, right? I may not have come in and had claim to these early retained earnings, right? If I'm a sort of a late bloomer, I got into that stock pretty late. I am really concerned, though, in the new type of retained earnings. And I'm also concerned about how any new shares potentially have been issued that will dilute my ownership interest in the company. So companies provide a statement of stockholders' equity to not just show how the company is performing and how the net worth of the company is increasing, but also to show investors, hey, here's how your stock is potentially being diluted if new stock is being issued. There's also other topics too, like non-controlling interest. This has to deal with the consolidation method of accounting. This is something for my grad students to deal with. Treasury stock, as companies buy back their own stock, it's necessary to show the explanation of that in the statement. Should there be any type of disclosure about this? Absolutely. Most of the time, companies will have some type of note disclosure associated with all these balances to provide context. We can look at some of these and say, all right, I can read these and understand what the heck is going on, right? But I'd like to get a little more history or a little more context behind these. That's why we have note disclosures. But overall, this is what we should see as the ending balance as of that company's fiscal year end, which is May 28, 2017. It's a weird fiscal year end date. Thumbs up if you guys are with me on this. Cool. Disclosure of restrictions on retained earnings. I don't see this very often. Just realize that companies may decide to earmark or restrict portions of retained earnings for payments of future dividends. It's possible. You just don't really see it that often. If they do restrict any dividends, they're going to make a disclosure about that and just explain the reason why. Sometimes they're doing it because debt covenants require them to do so. Any type of dividends or retained earnings that are restricted for any type of payment, not just dividends too. So just be aware that restrictions definitely require a note disclosure. This is required. Required if there's any restriction on retained earnings. And investors need to know when they look at retained earnings, is all of that available to be distributed, or has any of that been restricted or earmarked for any type of future payment to creditors or preferred shareholders? Which brings me into the next thing, the analysis, okay? It's possible that we have preferred shareholders. Preferred shareholders, as you know, are first in line to get paid their dividend. So if a preferred stock has, say we have outstanding 100,000 shares, this is preferred stock, 100,000 shares, and the 100,000 shares have a 5% dividend, okay? This is the value. If we have $100,000 worth of preferred stock outstanding and they're 5% preferred stock shares, then essentially it means roughly that every year there's going to be a payout that preferred shareholders should expect to get a $5,000 dividend. That's only if the company actually declares any dividends at all. If the company doesn't declare dividends, guess what? Your preferred shareholder, well, you're poop out of luck. You're not going to get your $5,000. And you cannot go and sue the company for your $5,000 either, because dividends must be declared. If the dividends are cumulative and this payment was skipped, then it means, hey, next year you owe me that. If you pay out dividends, that needs to get paid out first, and you need to pay me out any new year dividends as well. So that's how preferred stock goes. So preferred stock has to be paid out before the commoners, the peasants, they get the scraps, the leftovers, right? Preferred shareholders are royalty. They go in line first. So when it comes to any analysis, if a company has preferred stock, the analysis needs to incorporate any type of dividends that potentially need to be paid out to the preferred shareholders first. So down below, when we look at some common types of ratio analyses that we do, return on earnings or return on stockholders' equity, we want to look at the net income and subtract off any preferred dividends that would be paid out if the company declared any dividends. This results in net income remaining to commoners. So what's the net income for the commoners? That could be a lot, that could be a little, right? But we want to take that and divide it by the average common shares. So that way, when investors, if I'm a common stockholder, I can determine my true amount of return on equity. Generally, return on equity, if it's, you guys are probably used to also seeing return on assets is just net income divided by assets. So just realize net income in that case would also have to be reduced from any type of preferred dividends payouts. It's just a little nuance you need to be aware of. Generally in the problems I give you, I just tell you what average common stockholders equity was outstanding, but it's important that you and I just are very clear about averages, especially finance guys. There's a difference between a simple average and a weighted average. A simple average looks at beginning, adds it to the ending, and divides by 2. Most of you are probably used to that. Thumbs up if you're with me about that. Okay. Now, think about it like this. If I looked at your guys' first exam and I looked at the highest score, and then I looked at the lowest score and I divided it by 2, I could say, yeah, that's the average on the exam. I wouldn't necessarily want to do that because maybe that really high exam score is far out in the tail. So, or maybe the low exam is 0 because somebody didn't show up, right? So looking at simple averages is pretty weak. Weighted averages are far more superior because you look at the sum of all the observable numbers and divide it by the quantity of those observations. So I wouldn't just look at the highest score. I would look at student 1, student 2, student 3, and so on, add up all theirs, add up all those exam scores divided by n. That's typically what a mean average, mean or average is how it's calculated, okay? There's also things like median, and we can talk about those kind of things as well, but generally speaking, I don't want to harp on it too much. If I tell you it's average common shareholders equity, trust that it's probably something very accurate, like weighted average shares. So if you do have the opportunity to calculate, break down the numbers, you want to do that. Weighted averages are far more superior. Thumbs up if you're with me about that. Cool. So return on equity, if I give you some information, Beerbo had 360 net income, 54,000 preferred, 15,000 common, 2.55 weighted average shareholders equity. What do? Well, in this particular case, you ignore the common dividends. You just look and say 360 minus 54, that's the net income distributable to commoners, the peasants. Divide that by how much in weighted average common shareholders equity. So weighted average shareholders equity, this is common shareholders equity. So I'd have to yank out of that any type of preferred stock. When I do that, I can see, hey, company has this much that's been put in and earned by the existing shareholders. How much is available to distribute? Well, we can say that 12%. Now, why subtract preferred dividends? Because they have to get paid out first. I'm a commoner, okay? I know I'm last, so subtract out what needs to be paid off to these preferred shareholders. Some people say subtract off what also needs to be paid out in the future to creditors, but that's kind of splitting hairs. Net income is already net of any interest expense. So subtract out preferred dividends to see what is truly left over to distribute to the commoners. That's the goal behind this. 12%, is that a good number? Well, we can compare that to other companies. The payout, thumbs up if you guys are with me on this. Aviv, are you good to go on this? I don't see the top of your head. You're chopped off there. Payout ratio, cash dividends on common divided by net income minus preferred dividends. Again, if we're concerned about differentiating commoners versus the royalty, we need to make sure that any numbers that are based off of what we see on the income statement or the balance sheet, we take out the effect of preferred if we're going to look purely at common. So in this case, yes, I do want to take a look at 15,000 common shares, 50,000 in common dividends paid out to the commoners, but I want to divide it by the net income that's available to the commoners. So the company actually paid out of its net income available to stockholders. The company actually paid out about 5%. What does that mean? It means that 5%, that the dividends represent 5% of net income. You can look at it that way. Is that a good number? We would want to compare it to other potential companies and see what they're doing, preferably in the same industry. So if we're talking about Caterpillar and we're looking at heavy earth moving equipment type companies, we would want to compare all these ratios to those similarly traded companies. Book value per share. Generally, we're just looking at what if the company were liquidated. Take a look at common shareholders' equity. So subtract out any preferred stuff and divide it by the outstanding common shares. And that gives an idea about how much is going to be potentially go out to the commoners if there's a liquidation. Just something to be aware of, that is a potential ratio calculation, but it's based on book value, not necessarily based on liquidation value. Realize that companies, if they go bankrupt, they're not, whatever's left over in stockholders' equity, that may not be what book value is, because we're going to sell off assets at pennies on the dollar. So this is just another way of comparing companies and just say, theoretically, in a perfect world, the company liquidated its assets dollar for dollar, how much would go to the commoners? So if there's $100 million out there and 100,000 common shares outstanding, it would indicate that $10, every commoner has a 10% claim to the company's equity. So they show up in line and say, hey, I have 1 share of common stock, and the company turns around and says, here's your $10, sir, have a nice day. Again, not necessarily something I would put a lot of faith in. It's just something that companies can compare themselves against, assuming that they are a going concern. If the company is going to go into bankruptcy, you know that really you don't want to look at this ratio. It really doesn't have much meaning, because the amount that's going to be truly available to distribute may not be anything at all. Creditors get paid first, whatever's remaining will go out, but it probably won't be $1 million in this case. Is it a good ratio? Compare it to other companies. Let's see here. Mr. Rushing, you had a question. Mr. Rushing, you there? A question about, I think you had a question about the what occurs in extreme circumstances. Did you have a question about that you wanted to ask? I guess not. Okay, fair enough. All right, so here's what we're going to do. It is 11 o'clock on my side. Let's come back at 11:10, and I'm going to have you guys break out into your groups. So see you back in about 10 minutes. All right, thumbs up if you guys are with me out there. I see nobody's face. There we are. Hey. People are coming back here. All right. So just want to go into hide this panel. Just want to go into the Blackboard area. Chapter 15. Chapter 15, group work assignments. I have currently up 15.1, 15.2, 15.3 will be coming. I still owe you all your graded homework from the last two chapters. That is forthcoming. I still have a few left. I don't like to give them out piecemeal. I like to give them out all at once. So thanks for being patient about that. So go in and start taking a look at those when I break you out into groups. Make sure you know what is coming down the pike. Also in chapter 16, I've got, as soon as it opens up, I got the group work 16.1 available in the chapter 1 materials there. So if you want to take a stab, take a preemptive strike, and that you're welcome to. Are there any questions before I put you guys out in your breakout rooms? All right, here we go. Eli. Eli, are you there? There you go.